Hi, everyone, and thanks for joining in. This is a very important video because in this video, we would be talking about much talked about topic in terms of angel tax and what has happened, in the angel tax. And let me take you a little bit in the background in terms of what has happened and what is the background of this angel tax. So in this video, we will cover the background of the angel tax, what has happened, what amendment was brought in the Finance Act 2023, and then what is the notification which is brought in on 26th of September 2023. So the three parts we will discuss in detail and also understand in terms of its impact on the startups and valuation. So let us first start in terms of the background of this angel tax. So this angel tax, which is also which is there in section 56 to 7B of the Income Tax Act. So the Finance Bill 2023 has amended this section, and and which deals with tax on closely held companies, basically companies which are closely held and which are not public companies, wherein for issuance of shares to resident at a premium, which is basically at a price which is above the fair market value. You will keep hearing about fair market value के जो term है fair market value, उसके बारे में बार बार सुनोगे. The fair market value, if you raise capital at a price which is above the fair market value, then you will be taxed at the rate of 30.06% at the hands of the company under the head other income. Now this provision was always there, right? If you are raising capital from resident investors, and if your startup is not registered under DPIIT, that is the startup which are registered and accepted, recognized by the government of India. So if you are a startup who is not recognized by the government of India under DPIIT, and if you're raising capital from resident individuals or resident investors at a premium which is above the fair market value of the shares, then you as a company, as a startup, will pay tax at the rate of 30.06% under the head other income. Now this was always there, right? So there is no new thing to us. This was always there. Now what has happened is very interesting. In the Finance Act 2023, the government said that we are expanding the ambit of this provision, wherein now we will also bring in non-resident into the ambit of this section. So the objective of this change was to expand the scope of the section and bring shares issued to non-residents into the reach of the section. Now, so that basically means now that earlier, if you're raising from capital from outside India, then you were exempt from section 56 to 7B. That is, you were allowed to raise capital above the fair market value, right? But now the government has amended that, saying that even the non-residents are within the purview of this section. Now, what has happened to after this? That's what now, if you are raising capital from non-residents also, then you will be taxed under 30 at the rate of 30.06%, 30.6%, and as a startup you will still be taxed, right? And there was a big worry, and there was a lot of representation which was given to the government. Many of the VCs said that we are already in the startup investment winter, and there is a problem globally in terms of funds which are available for startups, and most of the funding which has happened in last 10-15 years into India in terms of large amount of funding, quantum of fund, is through foreign investors, right? For example, SoftBank, the likes of SoftBank, has put in billions of dollars of money into Indian startups, and the Tiger Global and other large, and there are smaller VC firms and mid-sized VC firms also, right? So there was a big problem, and everyone said that this will further derail the startup ecosystem because the startups will not be able to raise capital freely from investors outside India, because as a startup, there has to be a value discovery, and that value discovery at the initial stage will be based on the future of that startup, and that is where the problem is, right? Because on the day one, you cannot have the monetization model and the revenue and the clients and everything to prove that this is my value. So will always be a challenge. So the government brought in this provision in the Finance Bill 2023, saying that this provision of Section 5627B, which is also called the angel tax, will also be applied to funds which are raised from outside, funds which are raised from foreign investors. So there was a big problem everywhere, and people said that if you bring in this provision, there will be massive impact. Startups will move out, they will move out their capital. VCs might not be interested in investing into India because of the tax issues, because of the assessment issues, because of the tax notices. So the government should look into this in terms of what they can do, right? And so what government did, that government brought in a provision, a notification with some exemption post this amendment which was brought in, and the government said, okay, fine, if that is the case, then let me say that let me exempt sovereign funds or pension funds or broad-based funds which has got more than 50 shareholders or stakeholders, and they had listed 21 countries, that if you raise capital from these 21 countries, and if you raise capital from sovereign funds or pension fund from these 21 countries, then you are also exempt. So you are also exempt from this provision. So this provision will not apply to you even if you're raising capital from outside India, and that will not apply to you, right? However, the problem was that the countries like Singapore, Netherlands, Mauritius, Cayman Island, those countries were not mentioned in that exemption. And there was still a problem because there was no clarity in terms of how the valuation will happen, because there were some serious challenges in terms of how the valuation will happen. Now, I tell you what, the problem is so the angel tax falls under two provisions, right? Let me just jog your memory on this. FEMA and the income tax. FEMA is basically which covers the RBI and the income tax. And there may be confusion. I tell you why. Because there will always be difference between the valuation. There are always a difference between a valuation rule between FEMA regulations and the income tax laws per se. The FEMA norms provide for a minimum floor price. So the FEMA law says that this is the minimum floor price you have to in bringing funds from outside India. So it basically says that you shall not be issued at a value which is less than that value. So it can be said that so you decide that this is the value of per share, or this is the value of the per share of the company, and the FEMA says that you cannot raise capital below this value, and that might not be same as fair market value as income tax. So the fair market value of the income tax might be different from the FEMA valuation. Therefore, if the valuation done under FEMA regulation exceeds the fair market value. So for example, the fair market value of a per share of a startup is say 5,000 rupees, but the valuation as per FEMA is 7,000 rupees, because then as per FEMA you cannot raise capital less than 7,000 rupees. But as per income tax, you can do it at 5,000. So there was always a problem, and the valuation done under FEMA regulation will exceed, and that will invite scrutiny from tax department. Right. So this was always a problem, that in terms of how you will, because now you are bringing in foreign investors under the ambit of this section. So FEMA is also involved. Till now, it was only applicable to Indian investors. So there was no involvement of FEMA or RBI. So when FEMA comes in, there will be a challenge between in terms of how do you play the valuation between income tax and FEMA. So those were the challenges which were there. So the government on 26th of September 2023 brought in a further notification, and the government is now saying that. So the government is now saying that they have brought in 4 or 5 very important things to address the problems which has arisen because of this amendment, right? So the government says that the first thing is that this stays. So if you raise capital from foreign investors also, and if the valuation is above the fair market value, then you still need to pay taxes at the rate of 30.6%. That broad rule stays, right? Excluding those startups which are registered under DPIIT. So if you're registered under DPIIT, then these rules are not applicable to you. However, now, so what government is now saying is that fine, and that government had exempted those 21 countries for sovereign funds and pension funds. From those 21 countries, those were also exempted. Now what the government is doing, government has brought in 5 rules to value, to do the valuation in case of foreign investments. And these rules are basically the rule of comparable company multiple, probability weighted expected return, option pricing method, milestone analysis, and replacement cost method. So the government has brought in 5 rules, say that okay, fine, if you are raising capital from foreign investors, so that's fine. Can you value your startup and arrive at a fair market value using these 5 valuation rules? So this is number 1, which the government has brought in, which gives in a lot of flexibility in terms of, because earlier it was only book value and DCF, right? So book value and DCF might not work for startups because of the stage at which the startup is, right? So that's the number 1 thing which the government has brought in. The second thing which the government now is saying that deals which are done in 90 days window before and after equity capital raise from specified fund. Specified funds are funds which are specified by the government either in India or outside India from those 21 countries. If you are raising capital, then the valuation at which you have raised capital from these funds will be the FM value, and which will be accepted by the government as the price. So this is number 1, 90-day window, wherein if you have raised capital from specified fund, be it in India, SEBI registered funds, or be it recognized fund from these 21 countries, then that valuation also hold good. The second thing which the government has done is that they brought in a flexibility of 10%. So if there is a variance of 10% in terms of the FMV which has been arrived by the merchant banker, and at the final value, at the final rate at which the startup has raised capital, so they have given a safe harbor exemption of up to 10%, through which the startup can raise capital and there will be no problem, right? So I think these are the main thing which has happened. Number 1, if I can summarize, number 1, the angel tax will be levied on investments from foreign investors also. However, startup which are registered under DPIIT, they are exempt, they are out of it. If you are raising capital from those listed 21 countries from sovereign or wealth fund, you are out of it. Or if you're raising capital from other countries, then there are 5 methods which are given from non-resident, and there are 2 methods which are given for resident investors. You apply those methods, get a valuation done from a merchant banker, and prove that your at price at which you are raising is within the variance of the 10% safe harbor rule. Then you are out. Then you are fine. The next point is in terms of 90-day window, which has been given by the government, that if you have raised capital from a specified fund, be it in India or from those 21 funds, 21 countries funds, then, and within that 90-day window, if you raise another capital from unspecified fund, then the valuation of that fundraise will also hold good. And the government has also given five new methods of valuation, and there is a 90-day window, as I told you. The problem, so now larger question, does this solve all the problems of startups? That's the larger problem, larger statement. Now the 3-4 things. The evil is in the implementation. So how this implementation will be done is something which we have to see. Whether the assessing officers will accept the valuation which are being done by merchant bankers on ground at the time of assessment. This will be number one challenge. Also, many of the startups might still not fall under these 5 valuation rules if they're raising capital from outside India, because number one, you might not have comparable startups. There may be an innovative idea. There may not be any other method which may be applicable to you because you are unique. The third point, there will be enhancement in terms of compliance cost, because now you have to do an additional valuation which can be need to be done, and there will be additional compliance cost to raise capital from outside India. The fourth would be in terms of what happens to all the past investment which has happened in last 3-4 years from foreign investors. And if you remember, in 2020, 21, 2021, there was huge, the startup they have raised capital at a higher valuation, and now there is a correction in the valuation. So how the assessing officer on ground will look into this valuation is something which needs to be looked into it. Overall, it largely addresses points across, but there we have to see in terms of how implementation works. As I said, devil is in the implementation and how it works and how it pans out, and how do we ensure that there is no challenge in terms of raising capital from outside India. By the way, India is 3rd largest startup ecosystem in the world. We have 100+ unicorns, and the more clarity the government brings in terms of these things, in terms of raising capital, the more startups will continue to have their cap table in India and continue to build businesses and startups and solve larger problems of Bharat. So that's my take. And we will be continue to be updated on this, and happy to answer any query which you might have. Or if you want to ask anything from me, you can just drop a message to me, and I will be more than happy to answer your queries. So that's it as of now. And as we move ahead, we will talk about in terms of how the implementation will happen on this angel tax. Thanks for watching this webinar, and happy to connect again and on a different topic, and keep you updated. Thank you.